Welcome to the deep dive. Have you ever seen something that just doesn't quite add up?
Yeah, where what you're seeing feels totally disconnected from what you think should be happening.
Exactly. Like you're looking right at it and your brain says one thing, but the reality seems, well, completely different. That's kind of the feeling you get when you dig into the source material we've got today.
hmm
It's focusing on the Florida housing market right now, mid 2025.
And the picture it paints is striking.
It really is. The sources describe this scene. Huge communities, brand new homes, dozens and dozens still being actively built by major builders.
You see the construction cranes, the workers, the materials.
But then you look at the actual numbers, the data, and home prices across Florida are clearly, definitively falling.
It's a complete paradox.
Right.
It defies that immediate gut reaction.
Right.
We're sort of conditioned to see all that building activity and think boom times.
Hmm.
But this material suggests that, well, at least in the current Florida market cycle, that intense building tells a very different story.
The more concerning story, frankly, about where values might be heading.
Yeah, potentially.
So if you're listening, maybe you're in Florida, you own a home, maybe you're thinking about buying or selling, or maybe you're just watching from outside the state, kind of fascinated by these big real estate swings.
And you're scratching your head wondering, why on earth are builders going full steam ahead into a market that looks like it's cooling off?
Then this deep dive is definitely for you. We've got this compelling source material. You shared it. We've both gone deep into it.
Yeah.
Our mission today is to cut through that confusion. We want to unpack what's really happening on the ground, look at the data that explains this downturn, understand the huge shift in demand.
Pinpoint where prices are falling and why. Try to decipher what's driving the builder's behavior.
Exactly. And then tie it all back to what it might mean for you right now.
It's really about looking past just the surface activity, the hammer swinging,
Hmm.
and trying to grasp the underlying economic forces and market signals that the material is highlighting.
Okay, let's unpack this then. Let's start by really setting the scene. The source material kicks off with a very specific, vivid description. It's like you're right there, inside one of these large-scale home building communities.
Right, think one of those huge developments by a big national name like Lennar, maybe?
Yeah.
And the visual described is powerful. You're driving down streets just lined with brand new houses.
Not just dirt lots, right? These are well underway.
Oh, yeah. They're not just plans. Many are framed, walled, painted, windows in. Some even have lawns going in, dozens, maybe hundreds, in all these various stages.
But the key thing the material points out is,
That many look finished, ready to move in.
yeah,
And they are noticeably, almost eerily, empty.
no cars in the driveways, no lights on at night.
Exactly, no signs of life.
Yeah.
The material specifically mentions rows of completed townhomes, single-family homes, just sitting there vacant, waiting.
And this visual, this is presented as the core of the paradox we mentioned.
Right, because your first thought, seeing all that fresh construction, is the market must be incredibly strong. Demand has to be through the roof to justify building all this.
But the source material basically says, hold on, not so fast.
It directly challenges that assumption. It suggests that, while seeing builders everywhere was a sign of a hot market maybe 2-3 years ago, during that big pandemic migration wave.
Right, when everyone was moving to Florida.
Exactly. Now, though, in mid-2025, the material argues it's actually an indicator of the opposite trend.
So the visual cue that used to mean boom might now mean bust, or at least a significant slowdown.
Precisely. The argument is that this huge scale of ongoing building is happening despite really strong evidence of a weakening market, where prices aren't just flat, they're actively measurably falling.
The confusion comes because people see the building with their own eyes.
Yeah.
And it clashes with maybe news reports. They hear about price drops. It's a real disconnect between the visual story and the statistical reality.
And you don't have to dig too deep within these communities, according to the source, to see signs of that statistical reality actually playing out.
Like actual price cuts.
Big ones. The source mentions big price cuts coming straight from these builders.
Okay.
He gives specific examples from the area observed. In this particular big builder community, townhomes were being advertised, maybe even selling, for as low as $250,000.
$250K for a new townhome.
Yeah, and detached single-family homes right nearby were priced around $360,000.
And the material implies these aren't just like minor adjustments.
No, the description suggests these are significant reductions from where prices were maybe 6 months or a year ago. It reflects a real pressure on the builders to actually move this new inventory they keep finishing.
Which tells you right away they're not selling easily at their initial asking prices. They're having to slash prices on brand new homes just to get buyers in the door.
It strongly indicates that the organic demand just isn't keeping up with the supply they're churning out, forcing them into these aggressive tactics.
Okay, so the scene is lots of new, empty houses and builders already cutting prices significantly. Let's move beyond that visual now and look at the broader data the source material uses to really underline this downturn. What's the statewide picture?
The material cites data, probably from a major index like Zillow's Home Value Index, indicating that across the entire state of Florida, home values were down 3.5% year over year. This is as of mid-2025.
Okay, 3.5% statewide decline. That's not insignificant, especially after the crazy run-up we saw.
Right. But the material digs deeper, pointing out that the pressure is much more intense in certain spots.
It's not uniform.
Definitely not. In that specific area where the observations were made, Manatee County prices were reportedly down by a more substantial 6% over the last year.
So 6% in Manatee versus 3.5% statewide. That shows these localized pain points are much more severe than the average suggests.
Exactly.
Then the source material, it doesn't really pull any punches about how serious this trend might be, does it?
No, it argues pretty forcefully that this isn't just some minor mini correction, not a temporary dip that's going to bounce back quickly.
What kind of language does it use?
It's quite stark. The analysis presented views this as potentially a very serious downturn. The material explicitly states that if these trends continue, it could potentially be as bad as 2008 or 2009.
Wow, okay. That comparison immediately raises alarm bells.
It signals a level of concern far beyond just a normal market fluctuation. It suggests the underlying fundamentals are pointing towards a more prolonged and potentially significant price adjustment.
And a huge piece of that worrying picture, according to the source, is just the sheer volume of housing supply flooding the market right now.
Yes, excess supply is presented as a primary driver.
Let's break that down. What about the resale market first? Homes being sold by existing owners. Any numbers there?
The number highlighted for the resale market is pretty striking. 182,000 homes listed for sale across Florida.
182,000. How does that compare historically for Florida? Is that high?
The material gives that context. It states pretty unequivocally that this is the highest level of supply in at least a decade on the resale market.
So just looking at existing homes changing hands, Florida has more inventory sitting there than it has in 10 years or more.
Correct. That alone is significant.
And to really drive home how maybe out of balance that is, the material makes a comparison to another big state, right? Texas.
Yeah, and this comparison really highlights the scale of the supply issue in Florida. According to the data presented, Texas, which you usually think of as having a lot of building and a big population, has around 120,000 homes for sale on its resale market.
Okay, 120K in Texas.
Compared to 182,000 in Florida.
Yeah.
So Florida has almost 50% more resale supply than Texas right now.
50% more. Wow.
And the crucial point the material makes is that Florida has this much higher inventory despite having a significantly smaller population than Texas.
That difference is really stark. It's not just high inventory, it's exceptionally high relative to its population, especially compared to another major Sunbelt state.
It screens imbalance. It's a critical piece of the puzzle explaining that downward price pressure.
And as the material points out, this record high resale supply isn't happening in a vacuum. It's being added to
by all that ongoing new construction we started with. Builders are adding even more new inventory into a market that's already saturated with existing homes for sale.
Which just intensifies the competition further.
Absolutely. Pushing prices down across the board, both for new homes and forcing existing homeowners to compete.
Okay, so that's the supply side. Record resale inventory plus relentless new building. That's half the equation for falling prices. What about the other half, demand?
And the material describes an equally dramatic shift there. A massive drop in people moving into Florida. Migration.
How massive?
This statistic is maybe the most significant indicator of falling demand in the whole analysis. It reports that inbound migration, the number of people actually moving to Florida, has dropped by a staggering 80% in 2025 compared to its peak just 3 years earlier.
Wait, 80%? 80?
80% compared to the height of that pandemic-fueled moving frenzy.
That's not a slowdown. That's like the tap got turned almost completely off compared to just a few years ago.
It's a collapse.
What reasons does the material give for this? Why did the flood of people wanting to move to Florida suddenly dry up?
The number one reason identified is cost. Florida simply became too expensive, too fast.
That boom we saw.
Exactly. During that pandemic surge, home prices boomed about 50 or 60% over just 3 years.
Which is just unsustainable appreciation.
Totally. And the material connects this price surge directly to the current affordability crisis. It contrasts those prices with local incomes. It notes the median household income in Florida is still hovering around $70,000 a year.
Okay, 70 call a median income. How does that stack up against housing costs now?
The material gives a really sharp comparison using mortgage payments.
All right, I remember that.
Yeah, paints a clear picture. According to the analysis, the typical monthly payment on a Florida home, including principal, interest, taxes, and insurance, was around $1,000 a month back in 2019.
Okay, $1,000 a month pre-pandemic.
Fast forward to mid-2025, and that same typical payment has ballooned to roughly $2,500 a month.
From $1,000 to $2,500, that's a 150% increase.
A 150% increase in the monthly cost of owning a typical home in just 6 years.
And the material makes the obvious but critical point.
Incomes have not gone up 150% during that same time. Not even close. While wages have grown some, they haven't remotely kept pace with that explosion in housing costs.
So the gap between what people earn and what it costs just to pay the mortgage and associated costs is now huge.
Which leads directly to the consequence highlighted. A massive chunk of potential buyers, especially local Floridians, can't afford the houses at these price levels combined with current interest rates.
Or they just can't even get approved for a loan.
That might be even more critical. They can't even qualify for a mortgage because their income just doesn't support the debt-to-income ratios needed for these loan amounts. This just wipes out a huge segment of potential demand right there.
It shrinks the buyer pool dramatically. Now, besides affordability, which sounds like the main driver, did the material mention other factors pushing down migration?
It did touch on a few others. Things like, well, hurricanes. The increasing frequency and intensity is a real and growing concern for people considering moving there. Insurance costs related to that are also a big factor.
Sure.
There's also the element of people being called back into the office.
Yeah, the end of the remote work boom for some.
Exactly. Particularly those who moved from places like New York or Chicago during the peak WFH period might now need to return to their physical workplaces, reversing that migration trend.
That makes sense.
And the material also mentions a simpler, maybe more human reason. Some people who made that quick move during the pandemic might now just want to return to friends, family, their old social networks, feeling a bit isolated maybe.
Okay. So all of these things, but primarily affordability, combine to explain that huge 80% drop in people moving in.
Yes. And the material puts that drop in historical context, too. It notes that 2024 actually ranked as the 5th worst year for Florida migration on record.
Wow. So it's not just a return to normal, it's historically low inward movement.
It's a clear signal that Florida's attraction, at least from a migration perspective, took a major hit, mostly due to cost.
Okay, so the stage is undeniably set. Massive supply, dramatically shrinking demand. The result has to be falling prices. Let's get into the specifics the source provided about where prices are falling and by how much. This is mid-2025 data again.
Correct. Year-over-year percentage declines for various counties. In Manatee County, where the initial observations were made, prices were down about 6% over the past year.
And neighboring areas on the Gulf Coast, were they similar?
Some are even steeper. Sarasota County saw an 8.4% drop. Charlotte County, which includes Punta Gorda, was down 9.5%.
Almost 10% in Charlotte County.
Yeah. And Collier County, that's Naples, was down 6.5%. The material specifically calls out Naples because, some thought its high-end market might make it immune.
But it wasn't.
Nope. The data shows it's definitely getting hit, too. Even the wealthy markets aren't escaping.
Okay, what about further up the Gulf Coast? Tampa Bay area.
Pinellas County, St. Pete. Clearwater, that was down 5.9%. Hillsborough County, which is Tampa itself, saw a slightly smaller decline. It's still down 3.1%.
And Central Florida? Orlando?
The material mentions values dropping in Central Florida, too. Areas like Lakeland, Orlando, Osceola County are all seeing declines.
So it's widespread. What about the Atlantic coast, South Florida? Palm Beach, Broward, Miami-Dade?
The downturn is hitting there as well. Palm Beach County was down over 3% year over year. The source notes this is significant given how popular it was during the boom. Broward County price is also going down.
And the big one, Miami-Dade.
That's the interesting one. According to the data cited, Miami-Dade was actually still showing a tiny positive year-over-year gain, about plus 0.7%.
Oh, so Miami was holding up.
Well, hold on. The material immediately qualifies that. It points out that while the year-over-year number was barely positive, Miami-Dade was declining month over month pretty heavily.
Ah, The recent trend is down.
Exactly. It noted about a 0.5% drop in just the most recent month.
Yeah.
If you annualize that, it's like a 6% decline rate.
Yeah.
So the conclusion drawn was that Miami is also now going down. The downward trend is set, even if the 12-month figure hadn't fully caught up yet.
Okay, so really, virtually every major market across Florida is seeing price declines. It's not isolated at all.
That's the clear picture from the data presented.
And the material doesn't just look back. It includes a forecast for the next year, right?
Yes. Based on the analysis, citing data from the ReVenture app specifically, the forecast is for these declines to continue. Statewide, the expectation is for another drop of roughly 5.5% over the next 12 months.
Another 5.5% on top of the declines already seen. And what about those areas already falling faster?
The forecast expects them to keep leading the way down. Particularly on the West Coast, the prediction is for declines of 8% to 9%, maybe even hitting 10% over the next year in some of those harder-hit counties.
A potential 10% drop in just 1 year. The material really emphasizes why that kind of number in a single year is considered really, really big.
It uses that crucial historical comparison to the last big crash.
Right.
It reminds us that during the 2008 to 2013 period, Florida prices eventually fell about 50% from the peak. But, and this is key, that huge 50% crash took 5 years to play out,
Okay.
which means prices fell roughly 10% per year on average during that massive downturn.
I see. So if some areas are now forecast to potentially fall 10% in just 1 year.
It suggests a pace of decline that's just as fast, or maybe even faster, than the annual pace seen during the early stages of the last historic crash. That context really underscores the potential severity.
That's alarming. Looking beyond just the next 12 months, did the analysis offer a view on the total potential correction needed from current levels?
It did. The perspective offered was that given how much prices boomed, it's realistic to expect a 20% price correction from here on out in Florida.
Another 20% drop from where we are now.
That's the assessment. It's based on the idea that even after the falls we've seen, many areas are still significantly overvalued. The state average may be about 18%, 19% overvalued compared to historical norms. A 20% drop from current levels would, in theory, bring the market back closer to what the analysis considers normal, or long-term average valuation relative to incomes.
And the source mentioned Florida's history here, right? It doesn't always stay at normal.
Exactly. It highlights that Florida's housing market historically swings between extremes. It notes the period after the last crash, say from 2009 to 2018, was a time when Florida actually became very undervalued again.
When it was seen as a bargain.
Right. It was considered a deal to buy a house because prices had fallen so far below historical averages and fundamentals. The implication is that if this current downturn continues towards that potential 20% correction, Florida could swing from overvalued back towards being significantly undervalued once more.
It sounds like a market prone to boom and bust cycles, rarely just sitting at fair value.
That seems to be the historical pattern this analysis points to.
Okay, so we've got the high supply, the demand collapse, the falling prices now, and potentially more to come. But let's circle back to that initial head-scratcher. Why are builders still building so much amidst all this? The material offers some reasons for this seemingly irrational behavior.
Yeah, it's definitely counterintuitive on the surface. But the analysis explains that for these big national builders, their strategy in a downturn isn't just about maximizing profit on every single house right now.
There are other goals.
Yes. While profit margins are definitely getting squeezed, their goals are broader. A huge priority, especially for the giants, is maintaining market share.
Keeping their position in the market, keeping volume up, even if each sale is less profitable.
Exactly. The material mentions builders prioritizing maximizing their penetration into the market. They might accept much lower margins, maybe even minimal profit or a small loss on some houses, just to keep their operations running, keep crews busy, keep supply lines active.
And keep competitors from grabbing that share.
Precisely. It's a longer-term play for market dominance, sometimes at the expense of short-term profit per unit.
And the builders themselves, they know Florida is tough right now.
Oh, yeah. The material points out that CEOs of major builders like KB Homes, D.R. Horton, have publicly said Florida is currently their weakest market.
Yet they keep building.
Yet, as observed in that Lennar community, they are still building rapidly. The source specifically notes Lennar reported its worst first-quarter profit margin in a decade in early 2025.
Worst margin in 10 years, but the bulldozers are still going.
It shows they're absorbing that hit, but maintaining the activity level.
And to actually sell these homes in this tough environment, they're using tactics beyond just straight price cuts.
Absolutely. Price cuts are step one, obviously, competing with resale.
Mm.
But a major tool highlighted is financial incentives, especially mortgage rate buydowns.
Explain that again. The builder helps lower the buyer's interest rate.
Exactly. The source gives an example. A builder might offer a buyer a 5% interest rate when the open market rate is, say, 7% or more.
How do they do that?
The builder essentially pays a lump sum of money up front to the buyer's mortgage lender. This payment allows the lender to offer that lower rate, often for the life of the loan, sometimes just for the first few years.
And the big advantage for the builder is
It drastically cuts the buyer's monthly payment. That 2-point difference on a mortgage can mean hundreds of dollars less each month.
making their new home seem much more affordable.
Way more affordable and attractive compared to buying a similar resale home at the higher market rate, or even a new home from a competitor not offering that buydown. The potent tool to stimulate demand and move inventory when rates are high.
And it lets them maybe not cut the sticker price quite as much, while still lowering the buyer's actual monthly cost.
Right. Or it makes the sticker price cuts they do make even more impactful on the monthly payment. It directly attacks that affordability problem.
The material also made an interesting observation about the type of homes being built, mentioning lots of attached housing.
Yeah. It noted the prevalence of townhomes, or maybe larger houses that share a common wall, rather than fully detached single-family homes. It speculated this might be a cost-saving strategy for builders in this climate.
Saving money how? By building attached.
Potentially, in a couple of ways. Maybe some savings on construction costs, like foundations can be poured more efficiently in rows. But perhaps more significantly, attached housing uses less land per house.
Higher density.
Right. In areas where land costs are still a factor, or where they just want to cram more units onto a specific parcel, attached homes allow them to do that, potentially lowering the land cost per unit. It's likely another lever builders are pulling to manage costs and keep volume up when margins are so thin.
The source even asks the question, kind of rhetorically.
Yeah, like who's buying a floor plan like this, or would you ever buy in a builder community like this? It hints that maybe these designs aren't everyone's cup of tea, or perhaps the target buyer has changed.
And that point about land cost and density connects to a deeper argument the material makes about the actual value of the land under these houses, especially in these sprawling developments with tons of available land.
This is a really fundamental insight from the analysis. It argues that in these large-scale development zones where there's just tons of open land for miles around and builders are constantly churning out new similar homes, the actual land under that house is really not worth anything.
Not worth anything in terms of scarcity value, you mean?
Exactly, because the supply of similar land is effectively limitless in the immediate area. If you buy a house on plot A today,
The builder can just build the exact same house on plot B next door tomorrow, maybe even cheaper.
precisely, there's no inherent scarcity driving up the value of your specific piece of dirt. The value in these homes is almost entirely in the building itself, the structure. And even that value is constantly being challenged by the builder's ability to create more identical structures nearby, potentially at lower prices or with incentives.
So the common idea that seeing lots of construction means land values must be rising is wrong.
The material calls it a big misnomer, especially in this type of market in this phase of the cycle.
So in this specific situation,
The source is very direct. In this part of the cycle, it's a sign that your area is going down in value. All that building activity signals that builder supply is overwhelming demand, the land isn't scarce, and it's forcing builders to cut prices and offer deals.
which then forces existing homeowners who want to sell.
The resellers, yeah, they have to cut their prices further just to compete with the brand new, potentially incentivized homes down the street. So paradoxically, seeing all that builder activity right now, particularly in areas with lots of land, is actually a strong signal that values are likely heading down, at least for the next year or two.
That really flips the common perception on its head. Okay, so let's pull these threads together. Prices have dropped from the peak, but the material argues many areas in Florida are still significantly overvalued.
Yes, primarily because of that incredible 50–60% price surge during the pandemic boom. The analysis contends that even with the declines we've seen so far, some specific areas might remain as much as 50% overvalued compared to long-term price trends or local income levels.
That remaining overvaluation is key to the potential for more price
It
drops.
is. It suggests there's still room to fall to get back to historical norms.
But importantly, this overvaluation isn't the same everywhere across Florida.
Absolutely not. It varies hugely by location, county by county, even zip code by zip code. The material contrasts somewhere like Sarasota, which it suggests is less overvalued now after having a bigger correction already,
Right.
with somewhere like Palm Beach, which is still flagged as being very overvalued.
And knowing that difference, knowing how overvalued a specific area still is, has big implications if you're thinking about buying now.
It's presented as probably the most crucial piece of actionable advice for potential buyers in the material. The recommendation is, don't just look at state averages. You need to research the estimated overvaluation rate for the specific county or even the specific neighborhood you're interested in.
Why is that specific local number so important?
The logic is pretty simple. The areas that are currently the most overvalued, the places where prices shot up the furthest beyond historical norms and incomes, those are the areas that logically have the greatest potential to go down the most as the market continues its correction.
So understanding that local overvaluation gives you a sense of the potential future price risk or maybe future opportunity in that exact spot.
Precisely. It helps gauge how much further prices might need to adjust in that particular micromarket.
The material also touched briefly on the interplay between buying and renting in this market, didn't it?
Yeah, it noted the observation that some of these brand new builder homes are actually ending up as rental properties. Maybe investors are buying them. It used an example of a new 3-bed, maybe 2.5 or 3-bath house. It estimated that such a property might realistically rent for around $2,100 a month in that area.
$2,100 a month in rent. How does that compare to the cost of actually buying that same house?
The analysis estimated the all-in monthly cost to buy mortgage at current rates, plus taxes, plus insurance, would likely be closer to $2,400 or maybe even $2,500 a month.
So it costs significantly more per month to own it than you could likely rent it out for right now.
Exactly. There's a disconnect there. And the material argues this suggests that, just like sale prices, rents are also facing downward pressure. All this new supply hitting the market, some of it becoming rentals, puts pressure on landlords. The analysis says rents clearly they need to go down by more in places like this to make sense financially and attract enough tenants.
So the supply glut is pushing down sale prices and potentially rent prices too.
That's the implication. The source speculated those houses might eventually need to rent for $2,000 a month, maybe even less, suggesting potential further declines in the rental market are also likely.
It sounds like pressure across the board from this supply-demand imbalance. Now, amidst all this seemingly negative news, falling prices, overvaluation, pressure on rents, the material does conclude with something framed as a positive, right? The upshot.
Yes, it circles back to the idea that there's a good news aspect to this downturn, at least from one perspective.
Yeah.
The very fact that prices are falling and are forecast to keep falling.
It means that housing is going to continue to get cheaper in Florida.
Right, and the positive spin on that is that this trend will start restoring affordability to Florida's housing market.
Getting back to a time when average people could maybe afford to buy?
Exactly. The material reminds us what Florida was like before the boom, describing it as having been a really affordable place to live, mentioning that someone earning, say, $35,000, $40,000 a year back in 2019 might have realistically considered buying a house then.
Which became completely impossible for many during the peak.
Totally out of reach. So, while falling prices are definitely painful for recent buyers or current sellers, the material suggests that for future buyers, including locals who are priced out, the potential for significantly lower prices is the path back towards making homeownership achievable again in Florida. It's the market correcting that affordability crisis.
Okay, so let's try to wrap this up and connect it directly back to you, the listener. What are the absolute key takeaways from this deep dive into the source material on Florida's housing market circa mid-2025?
Well, I think the core picture is a market undergoing a really significant correction. It's driven by this potent mix, massive oversupply, both from record resale inventory and relentless new construction.
Combined with demand falling off a cliff.
Yeah, that 80% drop in migration is huge, driven primarily by that affordability crisis. Prices just outran incomes dramatically, plus other factors like return to office and maybe hurricane concerns.
And this imbalance is causing prices to fall now.
Demonstrably falling across almost the entire state, with some areas down 6, 8, nearly 10% already year over year. And the forecast cited suggest more declines are likely maybe another 5.5% statewide, potentially 8–10% or more in harder hit spots over the next year.
With the potential total correction of maybe 20% from current levels needed to get back to historical norms.
That's the realistic expectation presented in the analysis. And builder behavior, while it looks odd, is explained by strategies around market share and moving inventory, using tactics like big price cuts and those important rate buydowns.
Which just adds more downward pressure.
Exactly. It intensifies the competition for everyone.
And the crucial advice for buyers: understand the local overvaluation. Know how far prices might still need to fall in the specific area you're looking at.
That's key. The market isn't monolithic. Local conditions, especially how much prices still need to correct from the boom, are vital for understanding risk and potential future movement.
This deep dive has certainly unpacked a lot about a complex, fast-moving situation in Florida, all based on the source material we examined. We've hit the paradox of building in a downturn, the supply and demand data, the price specifics, builder tactics, the overvaluation concept.
It paints a clear picture of significant headwinds for the Florida market right now.
So as we close out this deep dive, it leaves us and you with a pretty big question to think about. The analysis suggests Florida's market could swing from being way overvalued to potentially becoming very undervalued again, like it did after 2008. If that happens, what does this current downturn ultimately mean for the long-term future of living in Florida? Does the prospect of much lower prices eventually create a renewed opportunity that outweighs the very factors, like affordability challenges relative to wages, or rising insurance costs and hurricane risks that cause demand to collapse this time around?
It's a fascinating question about whether the cycle just repeats or if underlying fundamentals have shifted more permanently.
Definitely something to mull over as these market dynamics continue to unfold.